Good morning, everybody. It is Tuesday, December 21st at 10 a.m. So it's time for our Tuesday webinar. Hope you're all doing well. Hope you're all gearing up for the holiday season. If you celebrate Christmas, Merry Christmas. If you don't, if you celebrate others, I hope you enjoy those events as well. We're running down, obviously, towards the end of the year. Just as a reminder, our office will be closed from noon on Thursday until January 3rd. If you're a client and this is something urgent, or there's something urgent that you need during that time, please feel free to reach out to us. Every one of our clients has my cell number, so you can use that. Jessica will be checking emails periodically throughout the week also if you need something there. So good to see you all. I hope you're having a good winter so far. And let's jump into it. So I just want to remind everybody, first of all, let me just say, if you're listening to this video or watching this video and on a recording and not live, you'll have an opportunity to schedule time with me if you need so in the by clicking the block underneath the video, and it has a link there. I also want to explain to you that generally these webinars are divided up into 15-minute intervals. So we have a short introduction. I do some slide updates for about 15 minutes. Then we go over market updates and analyst reports for another approximately 15 minutes, and a financial planning topic for approximately 15 minutes. So if you're looking for something in particular, if you're just here for the financial planning topic, which today is tax loss harvesting, you can go to the index for the financial planning topic. So I do want to remind everybody that you are muted. There's Q&A available at the bottom of the screen. Push the button at the bottom of your screen. Chat is disabled, and you, of course, are being recorded. So let me just first check in. Can everybody see me and hear me okay? Raise your hand for me if you can. Thank you, everybody. All right. So let's go back to my notes. As I said, this is the last webinar for the year. Our next webinar isn't until January 11th. So we'll be closed all next week. And then most of us are at a training, a team training event out of the area for that first week of January. And as I explained, that office is closed prior to that. We have a lot coming up as always. I scheduled David McKnight to join us on January 22nd. That's our first special webinar of the year, January 22nd. That's a Wednesday evening from 6:30 to 7:30. So David McKnight is the best-selling author of The Power of Zero, Look Before You LERP, Tax-Free Income for Life, and The Volatility Matrix. So, and speaking to Dave a week or two ago, he's busy writing another book. The guy just can't be stopped. So so that's going to be a webinar, January 22nd, our first special webinar from 6:30 to 7:30. And then we're going to have Dave here live in person on April 27th. We're going to have more details to follow. That'll be about the same time frame. It'll start at 6:30 in the evening. That's also a Wednesday. For you folks who attend my webinars on a regular basis, get these notifications, we are probably, most likely, going to have a VIP meet and greet event for just you folks. So that'll be, again, the details are still to be determined. That'll be also April 27th to where you can meet Dave live, get your book signed, things like that. And speaking of David McKnight, you know, I've spent the last several days over the past weekend catching up on Dave's podcast. So he releases one every, I think it's Monday morning. And they're really worthwhile. So wherever you listen to your podcasts, if you listen to podcasts, and if you don't, you know, they're really interesting. You should explore it. But wherever you listen to the podcast, search out The Power of Zero. He has really great guests. His topics are always very good. He's very informative. So it's a good use of your time. And I don't listen to him every week. Honestly, what generally happens to me is I catch up a few weeks at a time. But it's very, very good. All right, as I said, we're going to go into our normal discussion today, but our planning topic today is tax loss harvesting. This is probably the last thing that you can do for 2021 to help with your tax planning. So we're going to talk about what that means and how you might be able to pull it off in the next 10 days. Big headline this week, of course, it came out of last week. So last Wednesday, the Federal Reserve announced that they're going to be raising interest rates. So they're pushing this to fight inflation, which is the right thing to do. Maybe a little late, in my opinion, but they're going to. Obviously, the Fed rate has been near zero for some time, and certainly since the start of the pandemic. We started seeing interest rates rise just before the start of the pandemic. But they're talking about potentially raising rates 3 times in 2022. So there's a lot of discussion around what that means, or what does that mean when the Fed raises interest rates? Well, the idea behind that is, of course, to help slow the economy. So the U.S. economy, even with all the problems that we've had, the U.S. economy has been strong with all this stimulus money coming in. Because think about it, the companies and individuals got a lot of stimulus cash from the government, and they need to spend it. Now, individuals don't need to spend it, but they sure seem to want to. And companies were required, they had a timeline to spend those funds, at least on payroll and other certain requirements. But rising interest rates, of course, are going to mean that things are going to cost more if you buy them on credit. So will that help reduce prices? Probably on big ticket items like cars and homes, but not if the demand keeps the way it is. So we'll see. I think that we're going to see a reduction in home prices over the next 2 or 3 years, maybe 1 to 2 years. I don't know about auto prices just because of the supply issues, and it's a much smaller effect when interest rates go up on automobiles compared to homes, because a home's a bigger purchase. But I feel bad for the kind of the up and coming generation that's got to buy first time homes right now, because boy, I just don't know how you do it. Everything seems to be $300,000. When I was, I'm showing my age a little bit, but when I was first looking for homes, a $300,000 home was a big home. That was like, wow, big number. And now it barely gets you in a door. So, and that's in this area. I know other parts of the country, if you're tuning in from California or other areas, you're laughing at me right now, because that's nothing, $300,000 out there. So jumping into the slot updates, the first letter in question, and I think we actually only have one today. We do. There are a few good slot updates, but I just felt that they were really technical and also very focused with problems we don't see all the time. So we really have just the mailbag today, which has, let's see, 2, maybe 3 questions. So let's go through it. Then Ian Berger, I don't think you folks have met Ian yet. So we had Andy Ives on. We've had Sarah on in the past, and I don't think you've met Ian, but it might be worth it to have Ian on as well. You've certainly met Ed. The question here coming in is, I have a client, they write age 65, who passed away and left her IRA to her estate. Okay, first problem there. 2 nieces and nephews are beneficiaries of the estate. Is there a way to add beneficiaries after her passing? So the client's gone, right? Passed away. Can they then change the beneficiaries, because they don't want the beneficiaries to be the estate? It causes problems. It can make things, there's a probate issue, which isn't the end of the world, but if you can avoid probate as easily as naming a beneficiary, it probably makes sense. But that's their issue. So they don't have any named beneficiaries. It all goes to the estate. The person goes on the right, I spoke with a financial company and they said you need some type of court order or ruling to allow this. They indicated that it happens and is allowable, but gave no further details. This would allow us to change the beneficiaries to the nephews and niece, and distribution would be over 10 years under the Secure Act versus 5 years. So without a named beneficiary, they can't even be a designated beneficiary, right? That's the term. Not even an eligible designated beneficiary. That's someone who gets some more preferential treatment. But a eligible or a designated beneficiary has to withdraw the funds within 10 years. If there's no named beneficiary, then it reverts back to the 5 years, because it's now a non-named entity, and it's also not an actual person. So they said, I'd appreciate your input. And this person is Steve. So they write back, hi, Steve. Normally a beneficiary designation is etched in stone. It cannot be changed after the original account holder's death. However, in certain unusual cases, a court may be able to change the beneficiaries. Another however, even if that happens, the original named beneficiary is still considered the beneficiary for the IRA distribution purposes. So it's possible that a court could change the beneficiaries here and allow the IRA to be paid to nieces and nephews, but the estate would still be the beneficiary in applying the IRS payout rules. Since the client died before his required beginning date for required minimum distributions, this means all IRA funds would still have to be paid out by December 31st of the 5th anniversary of the client's death. So to sum it up, they are beat. There's nothing they can do to overcome that issue now, because even if they hire an attorney, they challenge this in court, they spend thousands and thousands and thousands of dollars probably to have it heard and have it have the court agree to, if the court agrees, to override the beneficiaries, naming the nieces and nephews. Then they still have to follow the 5-year rules because it reverts back to the original payout option for the beneficiary. So the IRS has this pretty nailed down, and there's no way of getting out of that. So that's unfortunate. And of course, how could they have overcome that? Check your beneficiaries every single year. Make sure they're listed as you want them to be listed. If for some reason you want your estate named as your beneficiary, you better understand that these are some of the problems that we're dealing with: probate, different distribution rules. So you've got to be aware of that, and the only way to be aware of those things is to know what your beneficiary designations say. And if you all are nodding your head, I know exactly what my beneficiary designations say. Well, you better be clients of ours, because we check them every single year. And if you're not clients of ours and you don't check them every single year, you should, because a lot of surprises are found out there. All right, so next question. Do adult children who inherit a parent's Roth IRA in 2020 need to make a required minimum distribution each year for the 10 years? Boy, this is a common question. Or may they leave it alone and deplete the account at the end of the 10th year? I've heard it both ways and would like to know which is correct. And this person's name is Pam. I bet she has heard it both ways, because I hear it all different ways. The answer is the children are not required to take an RMD, required minimum distribution, each year over the 10-year period. They have total flexibility to take all, some, or none of it over 10 years. The only requirement is that the entire account be emptied by December 31st of the 10th year after the passing, right? At the 10th anniversary of the parent's death. So December 31st of the year of the 10th anniversary of the parent's death, or whoever granted the beneficiary of the IRA. Some of your confusion may be because the IRS originally said annual RMDs were required. Remember that in the springtime, I think it was, the IRS came out and said, actually during that 10-year period, you have to take required minimum distributions. And we all said, wait a minute, that's not what you said before. So they did. The IRS came out and they said RMDs were required, but later the IRS acknowledged that it was a mistake. In written form, they acknowledged it was a mistake. So it's 10 years unless you're a eligible designated beneficiary. Okay. We talked last week about the CPI, Consumer Price Index increase of 6.8%. I don't want you to think I've forgotten about that. That's a big problem, of course, and that's a big topic of some of the analyst reports that we have today. But let's talk about the markets yesterday. And let's see, I'm just going to refresh my screen, see where we are just today. But they were calling for the markets to be up today, and I hope that's the case. But it's always good to see green on the screen, and it's taken a while. Oh, yeah, right now today at 10:15 a.m. Eastern time, the market is up 362 points. That could change dramatically by the end of the day. But last week, ending December 17th, the Dow Jones Industrial Average was down 1.67%. They were all down. 1.91% for the S&P 500, 2.94% for the NASDAQ, 0.57% for the MSCI World Index, not including the U.S. Emerging markets were down. They were all down. Bonds were up slightly, but still down for the year, down 1.33 for the year. you hear me say this all the time. That's going to be the tricky area going into rising interest rates. Now that we know that the Fed's going to rise interest rates, we've got to be really careful about how we're buying and holding our bonds. And the only way, in my opinion, to do that is find a very good bond manager. It's very hard to buy individual bonds today, but you've got to find a good bond manager, and that simply means either a separate account manager or a mutual fund. So that's the outlook for the markets, or what happened in the market, not the outlook for the market, but that's what happened last week in the market. Still strong numbers year to date: 17.71% for the Dow Jones, 24% for the S&P 500. So we've got another 10 days. Let's hope that we don't slide off more, or we at least stay close to where we are. Could it turn around drastically? Sure. But, if we end the year at 24, almost 25% for the S&P 500, nobody can complain about that. Just nobody can complain about that. It's a solid, great year. Not even just solid, but a great year. And we've seen great gains across the board in our various portfolios, and even the life insurance policies, and even annuities that the principal protected annuities that, we're shooting for a range of 3 to 5%. Many of them have been very, very strong. And again, if you're in one, and I'm speaking to one or two of you in particular, but remember that when we look at principal protection, and we see bond rates down at 1.33%, and your annuities are even up slightly, 0.5% or 1%, they've done their job for that period of time because they're not down. They've given you some protection and guarantees, and you're on the upside. And by the way, you didn't pay a nickel for that, depending on the type of the annuity you're in. Some of them have a small fee, but many of them have no fees, so that's great too. Because if you think about that, if you're in a managed account like a mutual fund, and your bond index is down 1.33, and then you're paying another 0.5% or 1%, well, your investments are down 1.88 or 1.83%. Even if you own an exchange traded fund with super low fees, and you're down, your fees are 0.05%, well, you're still down 1.38%. So it compounds the downside of things. That's a reason we have to be very careful about fees and costs. All right, so what are these analysts saying? Well, interesting. So BlackRock started this discussion group during the pandemic, and I'm not sure if they're going to continue it in 2022, but I hope they do, because in some way. So they gave a snapshot this week of what their portfolio managers are talking about around the globe. Now, listen, BlackRock is not the end all be all. We invest in some BlackRock funds. None of the things I mentioned, of course, are a recommendation to buy, sell, or hold any of these positions. But we do invest in some BlackRock funds, and we've kept some, we've gotten rid of some, and we may be getting rid of some going into next year. We have no connection with BlackRock, and we treat them. I always say I treat them like employees. If they're doing the job and they're doing what we expect them to do, and they're making us money, we keep them. If we don't, we get rid of them. All my employees are fabulous, though, my actual employees. But the mutual funds and exchange traded funds can come and go. I have no feelings about them. But BlackRock has a global network of analysts. They sit, they sit in the areas. If the group that analyzes China, they sit in China and Japan, and so they're all over the globe. So they have a group of portfolio managers to get together, and they talk about what they're thinking. And as you might think, they're pretty much split, and I've showed you that over these many months we've been talking that. It's just kind of like news channels. You can find a news channel that fits your thoughts and reinforces what you believe. Same thing with analysts. You can find an analyst who reinforces your thoughts, but you never know what's going to happen. So it's good to get, from an analyst point of view, forget what I said about the news this way, but from an analyst point of view, it's good to get both sides, because it keeps your mind open about things, and it also brings you back to the fundamentals that we always talk about. But BlackRock said portfolio managers this week discussed their risk appetite heading into 2022. So how much risk they want to take in the portfolios they manage. Around half have mixed appetite, mostly taking risk on large factors and not credit or equity. right? So the other half are split between high risk and low risk appetite. So that's really interesting. So they don't know what the heck to do. They don't know what it's going to look like. You've got one of the world's biggest organizations that are saying, well, we'll take risk on, the U.S. in general, right? And that's, I'm giving an example. So we're going to take a risk that the U.S. economy continues to grow, maybe not like it has over the past 18 months or so, but it'll continue to grow at a slow rate. But they're not even touching credit or equity. Credit is bonds. Credit is stock. Now, they're going to have to be invested in those, but they're saying they're not going to heavily overweight one or the other. The other half are split between high risk and low risk appetite. Again, I think you're going to see kind of a middling approach of, okay, we've got to stay invested, and we're going to probably very much a wait and see approach. So that's from one of the biggest companies in the world. First Trust, Prudential. I really like the way this analyst looks at things. I don't often agree with him, but I like the process he goes through. And I just have a couple bullet points. He writes, the past year was unprecedented in many respects and could mark a significant inflection point with respect to various long-term economic and investment trends. Perhaps most importantly was the gargantuan ascendancy of the federal government as an influence on economic activity. Nobody can dismiss that. Now, what we saw was the federal government stepping up, from the beginning of the pandemic and saying, we are going to backstop all of this. We're going to continue to push out money. The question is, how long can they continue to do that? And how long can we count on that? And at what point does it kind of shift to be, an open market policies to government market policies? And that's a bigger discussion. It's kind of crazy, but what we know right now is that the federal government definitely has a huge influence on the markets. That's why we saw that quick recovery we saw in June of last year was, because the government stepped in. That's why we weren't looking at a negative year last year and probably not looking at a negative year this year. And because the companies had what they needed. We had a significant outflow, a gargantuan outflow of money, into not only the company coffers, but individually through stimulus. The greatest economic and investment risks involve inflation going forward. Unprecedented monetary and fiscal stimulus may have sown the seeds of rapid inflation in coming years. How can it not? I don't know. You can't pump money into the economy and not have it drive up prices. And if you're doubting that, just look around you. Buy a piece of meat for your holidays. We were talking about a turkey breast, and my wife said, should I get this one? And I saw the tag and it was $30 for just a turkey breast. So that was a big no. Forget a brisket or something like that. You're getting really outrageous, and gas and all these different things we talked about. The costs, where I broke down the different sectors of increases last week. Historically, large amounts of excess liquidity have resulted in excess spending and sustained increases in the general price level. So he's just backing up, Byelich is just backing up everything that we've been talking about. With all this outflow of cash from the federal government, prices have to stay high, right? Inflation is probably going to stay high for some time. That's, you layer on top of that, every variant that's going to come down the pike. We've seen two significant ones already just in 2021. If you don't think there's going to be more in 2022, you're kidding yourself. So there's going to be a lot of pressures in 2022, and add to one of them, 2022, add to one of them increased inflation, probably going into 2023, even 2024. And I got to tell you, my opinion is we're still seeing higher than normal inflation going into 2025. That's my opinion, because I don't see it adjusting down that quickly. All right. So how do you, one more, Riverfront. Riverfront says stocks offer better reward to risk versus bonds, but likely to be a bumpy ride. Boy, they nailed that. So 2022, I think, is going to be a positive year again, potentially, absent any big bomb, so to speak, not literal bomb, I hope, but just big bomb. but it's going to be bumpy. I said that at the beginning of the year. I have it in my notes here. I carry these notes forward every week. But I have it in my notes here. Prepare for a bumpy ride. Now, it was pretty smooth until September, but I think we're going to see a lot of bumps in 2022. Don't forget, it's a midterm elections. They're always fun, right? So there's going to be a lot of uncertainty. Uncertainty always means volatility. Historically means volatility. And I think we can count on that. So key takeaways they give us is, in our base case, we believe U.S. stocks generate positive returns in 2022, but with more volatility. We start the year overweight U.S. stocks, Riverfront does, and underweight fixed income, that's bonds. The largest market risk we see is interest rates rising faster than we forecast. Can it get away from the Fed, right? Can they lose grasp of rising interest rates? It's actually absolutely possible. So, of course, what are our answers to these problems? Asset allocation, principal protection, and account segmentation. Make sure that you have what you need now to spend. Make sure you adjust your plan every single year, review your plan every single year. You have what you need to spend in the first several years, and that it's spread out over the rest of your life, and adjusting for volatility, adjusting for risk, and that you have a good portion that is set aside for growth, because you're going to have to overcome this higher inflation even over the next couple of years or few years. And the icing on the cake is if you can couple principal protection with guaranteed income. If you can do those things, if that makes sense for you, and not everybody, it doesn't make sense for everybody. Some people just need the principal protection, and that works in their portfolio. But if it makes sense for you and you can couple it with guaranteed income, boy, that's fantastic. And then, of course, if we're doing Roth conversions and we make it tax-free, well, my goodness gracious, that's the best thing going. Okay, so now let's move. Let me just see if we have any questions. One question. Let's see. Is it Gerard? No. It's Umberto. Hey, Umberto, I was just thinking about you. Good to see you. I'm glad you're here. Happy holidays, Mark. What's the latest on Roth conversions? Has the law been acted where prohibits any more pre-tax conversions from 401k or Roth? Is there any income modified adjusted gross income limits to be concerned about? The answer is not yet, right? Nothing's changed yet. So if you go back to our webinar last week, Umberto, and you can find that on our website under webinars. So I'll just share that with everybody quickly. Let's see. I'll show you where you can find it. All right, so you should see my website in front of you, and I have the tax chart pulled up. But if you go, so this is where you land when you go to attleborowealth.com right here. And if you go to events and webinars and into weekly webinars, you should see my smiling face all over. And it looks like we're up to December 7th. So when December 14th is up, I did a recap of where the bills are, where the legislation lies. But Umberto, if you send me an email, I've got a snapshot I can send you that'll give you some updates. So great question. Nothing yet, but all of those things you talked about, Umberto, are on the horizon, right? As a possibility. Rising income tests for Roth conversion. So if you make over $400,000 as a single person, $450,000 as a married couple, if that's what your income is, or your, I guess that would also be based on modified adjusted gross income. I'd have to look at the legislation. But so if you're doing Roth conversions or you have more than that in income, that's going to affect things. And then if you're trying to do backdoor Roth contributions, where you make non-deductible IRA contributions rolled over to a Roth IRA, they could be stopped next year, right? If something gets done in the next couple of weeks, or I guess they're probably done now, but it could happen early in the year. So all these things are still in motion. So I hope that answers your question, but good to see you. Yeah, send me an email. I'll send you that. And there's actually something I've been wanting to reach out to you about anyway. So this is a good time. All right. So what is tax loss harvesting? So it simply is, think about where we are right now. We've had some down markets over the past few months. Well, if you bought a individual stock or an individual ETF or a mutual fund right at the end of August, beginning of September, you may have some losses in that position now. And you might say, well, geez, that's showing red. How can I kind of make lemonades out of lemons here? And what you can do is you can sell that position. And if you follow what's called the wash sale rule, and we're going to talk about that. If you follow what's called the wash sale rule, then you can realize that loss. So you sell it and you buy it back 31 days later. Let's say you really like this stock or ETF or mutual fund. You sell it, you realize the loss, you buy it back 31 days later. So you still own the position, but then you've booked that loss for tax purposes. And it can apply a couple different ways for taxes. So it's a way, and you can still do it by the end of the year, right? But you've got to act fast. You can sell things, realize the loss for your 2021 tax returns, buy it back in January. You still own the position, but you've taken that loss. So there's some pros and cons, and there's some things you have to watch out for. But that's generally the idea. You can still own the position, realize that loss, get a benefit of for tax purposes, and then repurchase the position. Now, listen, we've been successfully doing this for many, many years. I can think of many cases. You know, I had one client that we changed their portfolio to something different. It was, I think, 2018 when we had significant drops at the end of the year. We sold, I think, her entire taxable portfolio, that one portfolio at the time, realized about a $60,000 loss. That's a lot. But then rebought everything 31 days later. And then as she was liquidating things, right, that she needed, she had some projects she wanted to do around the house, her portfolio rebounded, grew quite nicely. But as she was selling things, she didn't have to pay any tax on those, no capital gains tax. So it can work very, very well. But let's talk about the benefits and drawbacks. So let's talk about first about, hey, this will be fun. Let's keep it green. Benefits, right? Because that's positive, green money. So you can offset gains. So if you have losses in 2021 and then you have gains in 2022, let's just say your losses are, let's keep it simple, $10,000. And we're going to talk about short-term gains or short-term losses versus short-term gains and long-term losses versus long-term gains. But just simply, let's just use general gains. If you have loss of negative $10,000 in 2021 and you do the tax loss harvesting, then let's just say you have gains and you buy it back in January, right? Or 31 days after you sell it this year, you buy it back. At least 31 days. And let's say you have $10,000 worth of gains in 2022. And then you say, all right, you know what? I need to do something. I need to buy a new truck in 2022. So let's say you invested $50,000, your original investment. And then when you sold it, it was obviously worth, I'm going to keep it in red, I guess. It had a loss, remember, and you sold it for $40,000. And then you rebought $40,000 worth in 2022. Let's go back. I'm confusing myself with these colors. And then it grew, right? Let's say it grew significantly. I know it's a lot of growth in 2022. I'm trying to keep things simple. But let's say it grew to $60,000 in 2022, right? So that's a lot, I know. But so if you sold it, if you just are focusing on this, what I bought it for, what I sold it for, well, you would have $20,000 worth of gains, right? Here, if you then liquidated it, well, you would only actually have $10,000 worth of gains here. And you would be able to offset gains with those losses. So you would be able to offset $10,000 of that 20 of gains, and then you would end up with a net gain of $10,000. So in that example, doesn't really sound great, but if you if the losses are greater and they're collective, it can be really beneficial. Okay, so that's they're one of the benefits. Where it really applies is in this example, like I told you, this person had $60,000 worth of losses in 1 year, from their portfolio. We took advantage of those losses, sold them, realized them, and then we bought back the position. And in fact, they had later on, after we bought back the position, they had about $100,000 worth of gains. But as we were liquidating positions, we were able to chip away at this 60,000. So she would call and say, I need $10,000, right? So they had $100,000 worth of gains. So if you liquidate, and there's other ways to do that, but if you liquidate $10,000 and that is gains, well, what happens is you say, okay, well, back in 2021, we had $60,000 worth of losses. We use that to offset capital gains. So you pay no tax on capital gains, no tax. And now you bring down your capital losses to $50,000. So fundamentally, that is how you offset gains. Now, if you can't use it for gains, right? Or even in 1 year, let's say in 2022, you're able to completely offset any gains. Let's say, go back to the 60,000 here. You have $60,000 in losses in 2021 that you book. In 2022, you have $60,000 in gains. Doesn't have to be the same account either, right? If you have one account where you book losses and you have another account where you've got a bunch of gains, and let's say you want to sell out of this account at $60,000, then you can use this $60,000 in 2022. Realizing simply means you sold it and you've taken possession of the money, or you've sold it and bought something else. So you've realized those embedded losses or embedded gains that are in the account, because you see them on your statement. When you get your statements, you see, okay, I paid $10 for this. It's now worth $15. And so I have $5 worth of gains, or I paid $10 for this. It's now worth $8. I have $2 worth of losses. Those are what we call unrealized losses or gains. What I'm talking about here are realized. So it's either losses over here, gains over here. And in 2022, let's just say in one account, you had booked some losses and now you have gains. And again, you want to use them to buy a truck, remodel your house, do whatever. Well, you can completely offset this 60,000 in gains with the 60,000 that you had previously. And then you have zero capital gains, $0 capital gains. Now, if you can't use them all in 1 year, you have what's called a carry forward. So a carry forward simply means that you carry those losses forward each year on your tax return. So you've got this $60,000. And if you don't use it in 2022 or 2023, and then you've got capital gains in 2024, and you can use the 60,000 or whatever's left of that 60,000. I'll explain that in a minute. To offset gains, then you can do that. So you can carry this forward, do it here, and then you can use it later. All along, by the way, if you don't use it here in 2022 or 2023, you can write it off against income on your taxes. So each year, well, it's not a lot, it's $3,000. Each year you can say, okay, I'm going to use some of these losses and write it off against my ordinary income. So it's a little bit, this would take 20 years to draw down just on its own. But hey, even if that was the outcome where you realize some losses and you repurchase the securities at least 31 days later, then that's still a benefit. But if you can use it along the way where you have a year where you have big gains, for example, then that's really beneficial. So it is something you should look at every single year. So they're the benefits, right? You can get an immediate benefit every single year or as an offset to capital gains. And then you get that carry forward benefit where you can use it later for offset of capital gains, or $3,000 a year against your regular income. Drawbacks. We'll keep drawbacks in red. Drawbacks. Well, the drawbacks are opportunity cost. What if you purchased ABC stock, just as an example, in September of 2021, and it's down 30%, let's just say. So let's say you bought $100,000 worth of that one position, and now you're down $30,000. right? So it's worth 70 now. You bought it for 100, let's use $100 a share, and now it's worth $70 a share, and you put 100,000 into it, and now it's worth $30,000. And you say, okay, well, I'm going to harvest these losses, and I'm going to do it today. Today is 12/21/2021. That's interesting. Let me move this thing out of the way. All right, so if I did that in 12/21/2021, and I sold, right? I sold positions at $70 a share. You got to consider transaction costs too, right? There's transaction costs built in here. That should also affect your losses as well. But if you pay transaction costs, and now let's say 1/22, as long as the math works on the days, you repurchase this ABC stock. Well, the problem is that what's the price difference between December 21st, 2021 and January 22nd, 2022? Is it guaranteed to be the same $70? Well, of course not. So it could be higher, it could be lower. In your case, if it's lower, that's okay. That works out for you, right? Because now you're buying at a lower cost. If it's higher and it's back to $100 a share, well, you've lost that opportunity cost to really go back to that $30 a share, and that's significant. So if you think your position is going to move very wildly like that and it could recover, I think of things like the ARK funds or Tesla or something that's been really not a recommendation to buy, sell, or hold any of those positions. I'm thinking of the things that are really moving wildly. So, things do move like that. So if you think that your position is going to move wildly, well, then you might want to hold off, or you might want to consider it or do a portion of it, because that's really the drawback of it. Okay. And of course, these things have to live in the taxable bucket. Remember our buckets: taxable, tax deferred, and tax free. When we're talking about tax loss harvesting of capital gains, well, that can only happen in this bucket here. Don't let anybody tell you that you can do it in a Roth or a traditional IRA. It's not going to happen, because you've got to have realized short-term gains or long-term gains for that to happen. Now, let's go to this tax table here, and let's talk about what we're talking about short-term gains and long-term gains and capital gains. Now, you might remember that long-term gains generally are anything you hold for greater than 1 year. Short-term gains are less than 1 year. Long-term gains are taxed at this table here, right? So 0, 15, or 20%. You got to remember, if you make more than $250,000 in modified adjusted gross income for a married filing jointly, or $200,000 for a single filer, you're going to pay an additional 3.8%. That's very important. So it could be 0% in this bracket, this section here. You see the income levels. So you could have capital gains rates of 0%. It happens all the time. 15% here, 20% here, tied to these modified adjusted gross income levels, plus the potential 3.8%. So it could be as high as 18.8 or 23.8. So remember that and pay attention. Short-term capital gains, well, they live in ordinary income tax rates. So these are tax tables we're certainly used to seeing, right? Because this is where we judge how much we're doing in Roth conversions, how much you're paying your effective tax rate. So if you have $100,000 in short-term capital gains, they're going to flow right into here, and you're going to pay that based on these marginal tax rates, not the long-term capital gains rate. So that's an important distinction. So it does get a little confusing there. So it's got to live in this taxable bucket, not tax deferred, not tax free, not Roth, not cash value life insurance. It's got to live in this taxable bucket. And these are the tax rates that apply to short-term gains and long-term gains. Let's make that a little smaller so you can see it all together. Now, there are offsets. So if you have $10,000 in gains, long-term gains, and you have $5,000 in gains, that are short-term gains. And if it's really simple and you have $10,000 in losses that are long-term and $5,000 in gains that are long-term or short-term, sorry, then these cancel each other out, right? So then you pay no capital gains tax. If you have $20,000, let's change that and make it $20,000 in long-term gains and 0 short-term gains, but you still have $15,000, right? $10,000 in long-term gains, $5,000 in short-term gains. Does that mean that only the $10,000 of the long-term gains is canceled out here, and then we got to carry forward the other $10,000 carry forward like we talked about before? No, the remaining $5,000, if you don't have short-term losses, gains, they should be losses. If you don't have short-term losses, that can be canceled out by the other $5,000 worth of long-term losses, but then you end up with $5,000 of carry forward. Does that make sense? Let me see if there's any questions about that. And it can work the other way too. If you have a lot of short-term gains, short-term losses and a lot of long-term gains, then the other one, they cancel each other out first, and then it applies to the other. Now, if you're holding a lot of short-term losses, you might want to consider not applying those to long-term gains if you can, because remember, they're generally taxed at a much higher level. So if your capital gains rate here is at 15% and your marginal income tax rate is at 24%, so maybe your effective tax rate is 20% or 22%, then it might be better to hold those short-term losses to offset against future short-term losses to avoid this marginal income tax bracket. So and instead pay capital gains. Does that make sense? Or offset those? Because there's more value in short-term losses than there are in long-term losses because of the difference in the tax structure. I hope that makes sense. The next thing, so we talked about opportunity costs. They live in the capital bucket. How we have to purchase them and what is the wash sale rule? There is a thing that you've got to follow called the wash sale rule, and that's where I get the 31 days. So the IRS says, I'm going to read it to you here. The wash sale rule states that your tax write-off will be disallowed if you buy the same security, a contract, or an option to buy the security or a substantially identical security within 30 days before or after the date you sold the loss-generating investment. It goes both ways, before or after. One way to avoid a wash sale on an individual stock while still investing in the industry of the stock you hold at a loss would be to consider substituting a mutual fund or exchange traded fund that targets the same industry. Let's talk about that. So the wash sale rule simply says you can't have it both ways. You have to wait that 30 days, either prior, 30 days before, here's ABC stock, or 30 days after. Now, if ABC invests in biotech, and you said, well, I don't want to lose that opportunity cost. I want to make sure that I'm still involved in the market, that market in particular. I can sell my ABC. So we're back to 12/21/2021. I can sell my ABC stock. I can buy a biotech ETF or a mutual fund, still be in the market and hold that for the 30 days. And then if you wanted to, you don't have to rebuy these things. It's only if you want to. I want to be clear about that. Many people get stuck with that. You don't have to rebuy ABC stock. If you want to, you can, but you don't have to realize the loss. So the wash sale rule applies if you want to rebuy the position. If you want to still own the industry, well, you could just buy into a biotech ETF, for example, and still be fully invested and realize whatever loss you have in our example of ABC. If you just want to be done with ABC and move on and invest in energy or whatever, another security, another stock altogether, XYZ, you can do that. Even if XYZ and ABC are in the same industry, you can do that. So it's just you can't do things. People try to get cute. They say, well, I'm going to buy an options contract. I'm going to I'm going to do some derivative of ABC. That's going to negate, and it's going to trigger this wash sale rule, and you're not going to be able to take advantage of it. I have a question here. Let's see. No questions today. Nice time. Gerard says, no questions today. Nice to have honorary mention. Happy holidays to you and your family. Same to you. Thank you, Gerard. Gerard always, as you know, if you listen, has great questions all the time. All right, so that is the wash sale rule. There's a really good description of this on Fidelity's website, and I just Googled wash sale rule, and one of the best versions I found, because I try to find things that you can reference, is at fidelity.com, and it's simply tax loss harvesting. So that's, they talk about the wash sale rule. There's a link right to the IRS section that discusses that. But just like anything else, folks, if you've got complicated positions, because I'm going to get into lots in a second, you've got to utilize your team. You got to utilize it CPA, our team. We're going to help you figure this out. That's our job and your CPA's job. So now let's talk about where do we get this information about, okay, remember I told you on your statements, it shows whether it's gain or a loss. Well, that refers to what we call cost basis, or sometimes just called basis. So if you own a position that's worth $50,000 and you bought it for $30,000, and let's assume no dividends just to keep things easy, then your basis is the $30,000. So of course your gain would be $20,000. Now that could be that simple. Back to ABC. You could have bought ABC last year, let's call it 12/21/2020, and it's grown $20,000. But that's a lot of times that's not how it happens. Sometimes you buy 100 shares of ABC on 12/21, and you bought 100 shares of ABC on 6/21/2020, and you bought 100 shares of ABC on January 1st, 2020, or whatever the first market day was of 2020. I don't know if it was the third, but that sounds right. So your basis could be all over the place, right? And these are what we call lots. So you got a 100 share lot here, 100 share lot here, 100 share lot here. So let's just say that of this $30,000, you've got $10,000 that you invested here, $10,000 you invested here, and $10,000 you invested here. But let's say this $10,000, you bought at a much higher price. And while it's worth $50,000, maybe you paid, maybe you're showing a that would be a lot, but let's just make it simple. Maybe you're showing a $2,000 loss on this one lot, but you're showing gains, significant gains, $5,000. What are we up? 20,000. Then this goes as plus 15,000 on these two lots here, right? So you could have a loss in one of these lots. Now, if you want to, you can just sell this lot. You can go in, or we go in and we sell just this one lot, because you might say, hey, well, listen, I can't do any tax loss harvesting because I bought ABC for $30,000 and it's worth $50,000. And we might say, well, wait a minute, let's look at the lots. You bought a lot on January 3rd, 2020, and that's down $2,000, that one lot. The other ones are still up. And I know these are extreme examples, right? Up $15,000, up $5,000. I know that's a lot. But this one could be down, even though these are up. So you could sell just this lot, just this 100 shares of ABC, realize the $2,000, buy back, let's say you really wanted to own ABC. Well, of course, 31 days later, you buy 100 shares or whatever you want of that of ABC. And now you've realized that $2,000, you can offset it back on other capital gains. You can carry it forward into one other following year, right? Because you can use up to $3,000. So you can use your $2,000 there. So I know it's complicated. It is something that you can do by the end of the year. Still, You've got to get cracking on it though, because it takes some looking at things. It takes sometimes it's very simple, sometimes it's more complex. Make sure you don't run afoul of that wash sale rule, because that can just ruin all your good efforts. And listen, it also doesn't always make sense. Just because you have a loss in there doesn't mean you have to take advantage of the tax loss harvesting. But it is a way, especially when we're looking at downward markets in the end of the year here, it is a way to take advantage of some losses, and you can repurchase those securities after 31 days. Technically after 30 days, I like to go 31, make sure, again, I count the days on the calendar to make sure. But you also don't have to. If this is a position you're done with, you want to move on to something else, then that's a really easy one. You don't have to wait the 31 days. You can just exchange it for another position, or maybe you make it simple and put it in an ETF. Yeah, Walter says, need to tell your broker pre-sale which lot you are selling. Cannot decide after the fact. That's correct. You got to decide those lots. You've got to choose them on your system if you're doing it yourself, or we do it. Penalty for a wash sale, Don, you don't get the loss. It's like it never happened, which really stinks, right? So it's timing, right? You're just timing the purchase and sale of the position. You still have you would still have the realized gains and losses. You just can't offset them otherwise. So good questions, everybody. Really, really good questions. So let me close these out. Okay. Well, I hope that was helpful. So we covered a lot of territory in a short period of time. It's 11 o'clock, 10:59 actually. I hope you all have a great holiday, whatever holiday that you celebrate, or maybe you just take some time off and enjoy this wonderful cold weather we're experiencing here in the area. And if you're in Arizona or Florida or some of the other places, California, there's some folks out there. I'm jealous. I wish that I was enjoying the weather with you, and maybe I will soon, just to visit. I'm not going anywhere anytime soon. But we went over the slot updates. We went over some market updates and some analyst reports, and we talked about tax loss harvesting. Let me know your thoughts on this webinar. Let me know your thoughts about going into 2022. If there's anything in particular that you want to see or talk about, it's always good to hear from folks. And I wish you all the best. And I'll see you in a couple of weeks. So no webinar next week, no webinar on the 4th, and we'll see you on the 11th. Looking forward to a great 2022 with you all. Take care. Bye-bye.